In this episode, we're going to talk about why returns can vary from account to account.
Welcome everyone, thanks for tuning in to today's episode. Recently we've had a couple of questions come up around performance in certain investment accounts. So for example, a client could ask, my TFSA or my tax-free savings account didn't do as good as my RSP. I really want to be invested in whatever my RSP is invested in.
Yeah.
This is actually an asset location kind of tax strategy that we use, and there's a reason why you see variance from account to account.
Yeah, and we see this a lot more with our balanced clients in particular, or balanced or even conservative clients who have a multi-asset class approach to their investments, which is the vast majority of our clients, in fact. And the point that you're hinting on is that when we look at the portfolio, it's not what you earn, it's what you keep. Really, that's important, and we harp on that. But we also have to plan for not just returns, but we're also planning for tax efficiency as well in that. And in any case, anytime you have like a balanced or a diversified portfolio, the whole point of it is that not all the investments move in the same direction. Mm-hmm. And so there's going to be situations where the stocks are working better than the bonds are, or the real estate is, or vice versa. The real estate, bonds, infrastructure could be working better than the stock market is. And so there's going to be situations where certain accounts might not have performed as well as the other accounts, which is why I would encourage look at the portfolio as a whole versus just one little thing, one little holding, or one little account at a time. But
so as you alluded to there, we do a lot of planning work. We're a planning first team, and we do a lot of planning work, and some of that planning work revolves around, like you said, making sure that your whole portfolio is as tax efficient as possible.
Right.
Part of that is designing a portfolio to take into consideration the type of investment returns that you are getting, because all different types of investment returns can be taxed in different ways. So I think to first get into asset location, let's talk about the different types of returns you can receive as an investor, and we'll go from there.
Yeah, I mean, that's really important to understand where your returns are coming from. Most safe investments and more traditional investments, if you think about like bank accounts, savings accounts, GICs or guaranteed investment certificates, even bonds, those types of investments, which tend to be the lower volatility investments, will pay their growth in the terms of, or the returns in the form of interest. Now, for tax purposes, interest is taxed at the same level as income is, which is essentially at your highest marginal rate.
So it's the least tax efficient.
Correct. So that's the highest tax. One step away from that would be dividends. Now, I'm not going to get into too much detail on how the dividend tax is calculated, because it's a more complicated issue that we should do one-on-one. But essentially, especially when you're talking about Canadian companies that are paying dividends in your portfolio, that is a little bit more tax preferred than interest. So interest you're paying here, dividends from Canadian companies you're paying here. And then the third level, which would be the most efficient in the investment world, is capital gains. Now, as of right now, capital gains are only charged at a 50%. You're only charged tax on 50% of your capital gain. So let's say you made $100 growth in one of your investments. Take that down by 50%. So $100 capital gain is taken down to $50 for taxable purposes. Take that 50, and that essentially goes on your tax return as it would like income, but you're only paying tax on half of that capital gain. So that's the most tax efficient investment you can get. So if you had to choose the tax you wanted to pay, you would always pay capital gains versus the other ones.
But like you said, most of our clients have balanced portfolios, and they're getting all these types of investment returns, and so that brings us back to the asset location. Where are we holding investments in what accounts so that we make sure that you're keeping more in your pocket after tax? So why don't you start with RSPs?
Yeah. So this is really important for especially people that are maximizing out their tax preferred investment accounts. So RRSPs tax-free savings accounts we throw in there as well. But RSPs, for this case, anything that goes in there, you get a income tax deduction for dollar, based on what you put in. But when the money comes out, you're paying tax on dollar for dollar what's coming out of it. So think about it. If you take $100 out of your RSP, it's like having an a paycheck for $100, okay? And you're getting taxed like that. So because of that, and if you go back to what I was just saying about what investments are taxed in different ways, if we're already getting charged as income on interest returns, and in an RSP account, when we pull money out of it, if we're paying income like tax as well, then it makes sense that there's no benefit of having that interest-bearing investment outside of an RSP. If we can, we'd hold all of our interest-bearing investments in the RRSP because they get taxed the exact same way no matter what. And that way we can hold other tax-preferred investments like Canadian dividend companies and capital gain earning investments outside of an RSP, where we're going to pay less tax on it than we would if we had our bonds or GICs and things like that outside of it. So that's a situation where, getting back to the whole point of this is, let's say we had a maximized out RSP and we had other investment accounts, other investments outside of that account in what we would call a non-registered account or a taxable investment account. Well, we would hold all of our bonds, all of our GICs in the RSP, we'd hold all of our Canadian dividends and all of our capital gains earning investments outside in the taxable account, and by doing so, we're going to pay the least amount of tax possible.
What about tax-free savings accounts, Grant? What should we be holding in there?
Tax-free savings accounts are fantastic accounts because, as the name suggests, all the growth in there is tax-free. So again, anytime we get an opportunity where we're not going to pay tax on our investments, we want to hold potentially the highest earning taxable investment in there. So right away you go back to what I previously said. Well, that's the interest bearing investments. So I'm going to throw on just one caveat here, because this is for a really well balanced portfolio, or maybe a conservative portfolio where they have that much amount or that big of an allocation of interest bearing investments. If you're a stock investor, like more of a growth investor where you got large capital gains potentially coming, and you think you have high growth investments, you might want to hold those in your tax-free savings account, because if their capital gain is going to be that much bigger than what the interest is on a bond or a GIC, then that might be your better more tax preferred way of doing things. So again, everything has to be customized, but on a high level, if we're just talking about generalities here, you try to earn, you always want to hold your highest taxable investments in your registered money, because either it's going to be in a tax-free savings account that's tax-free, or in an RSP where it's taxed the exact same anyway. Hold your lowest earning taxable, your lowest taxable investments in the non-registered accounts, and by doing that, your returns actually are the exact same overall, but the amount of tax you're going to pay, and therefore the amount of money you're going to keep, is much higher.
I know you touched on this, Grant, but I want to make this point before we close off the episode today. As it relates to asset, we're talking about asset location here. If you're a young investor or an investor who just hasn't utilized their contribution room for your TFSA or your RSP, asset location is less important, and you should be focusing on using that contribution room to allow your investments to compound tax-free. So
yeah, I mean, again, always take advantage of any tax breaks you can get from registered accounts. So if you haven't maxed them out, you should definitely be taking advantage of it. Especially young investors, tax-free savings accounts are great accounts. They're incredibly flexible, so there's no reason not to use them, unless you're in a high income tax bracket, in which case an RSP might make more sense. But those are great accounts to use until you max them out, and then you can start getting into asset location a little bit more.
Great. Well, with that, we can close it off. Check us out, www.whitehoustonwealth.com. You can send us an email at whitehoustonwealth@mbc.ca, and we'd be happy to answer any questions. If you have something that you'd like us to talk about, shoot us an email, and we'll go from there.
Ready?
Aim.
Fire.